Let's start with the elephant in the room, because you guys are nervous Nellies. Oh my God, everything is so scary. The crypto went down 5%. We're all going to die. I'm going to lose all my money. Didn't you show me this chart of global M2 and Bitcoin? Doesn't it mean the Bitcoin's going to 70,000? Calm the down. You all need to grow some cojones, and you need to learn stoicism, inner peace, meditate, do anything but stop bleating on Twitter about your fears all day. If we did that anywhere else, people would get really bored of us. I get really bored of it. So let me talk you through why you should stop your bleating. Firstly, in 2017, we had a new president of the United States that shocked everybody getting voted in, called Donald Trump. He came in on a ticket of tariffs and trade war and onshoring and tax cuts. And now we have a new president called Donald Trump, who is coming in a few days' time on a ticket of tariffs, trade wars, tax cuts, and deregulation. Sounds kind of familiar, right? Well, remember the M2 collapse that we're seeing now, and oh my God, my Bitcoin is going down to 70,000. Do I sell? Do I buy? What do I do? Help me. What does it mean for my shit coins? Okay, it all happened back then too. Global M2 sold off. That was because the dollar went up. So we had exactly the same repeating pattern, which kind of says that global M2 should probably base around here. Again, don't expect perfection, but expect some repeat. Oh, the NASDAQ did something similar too. It would suggest the NASDAQ should be going up pretty sharply now. And lo and behold, today, the NASDAQ has a really strong day. Feels about right. Old Trumpy boy's about to come in. But it's about the dollar. The dollar's been strong. That's what's been driving global M2. And guess what? It was identical back then too. Now, this chart's been copied by every on X because they're too lazy to do their own research. Started with us, as all these charts did. The M2 charts, all of them, was myself and Julian Battelle, a global macro investor, and then Real Vision Pro macro, and then we spread it further with the world, and they all get copied. But I guess it's flattering. What it's suggesting is Scott Bessent speaks, I think tomorrow. He should start signaling, along with Steve Mirren, that the dollar is too strong and it needs to weaken. The dollar is being used as a weapon against China, Europe, Canada, and anybody else who has trade deals to do. They've all got weak currencies. It's a problem. The US also wants a weak dollar, but they know a strong dollar forces people to the table. But we also know they've already been negotiating. So what we're likely to see is talking the dollar lower from Scott Bessent. It is very important they do so because the US needs to increase its exports. Everybody needs the economic cycle to increase. The Chinese, well, we need them to stimulate because without the Chinese, we don't have a global economy. We have a lopsided economy. And for them to buy US goods, their economy needs to be growing. But they need to stimulate. But if they stimulate with the dollar too strong, their currency peg breaks, and they don't want to do that because then you get capital flight. So it's a very fine balancing act of geopolitics and economics and interconnectedness and this kind of global dollar system that they need the US to weaken the dollar. If the US weakens the dollar and injects liquidity into the eurodollar market, which is the offshore dollar market, the Chinese can access it and they can roll their dollar debts. They can start doing quantitative easing. They can start stimulating massively. The global economy can start recovering. They can start buying US goods. Everybody is a winner. So the dollar will come lower. I've known Scott for a long time, and he understands the big picture. Crypto, here's Bitcoin, following the same pattern roughly. 2017 has been my base case for a while. Do not expect it to be identical, but, and do not expect it to be going to wherever the scale says. I'm not looking for $1 million Bitcoin. Sure, there's a probability, but it's like 5%. But directionally, we should get this right, and it should continue to rally into the end of the year, into 2025, and maybe into early 26. We'll have to wait and see. But this is what the pattern tells us. It's repeating the same pattern. Bitcoin should be up only from here. And this is the typical post-correction halving. So what we have is the start of the banana zone, which we talked about from about September, and that was when Bitcoin hit 50,000. So the first banana zone phase one, that was this period here as we come up from the sell-off from the halving. Then we have the correction from the banana zone phase one. Happens every time. Then what do we get? The banana singularity. That's the next bit, when everything just goes up. And it makes us all look like geniuses. Every stupid shitcoin we've ever bought goes up. Everything goes up. And we think we're gods, which we're obviously not. We're probably just morons trying to do our best. But luckily, crypto market, it trends up over time, so it kind of covers all sins. As long as you're not too far out the shitcoin curve, you'll generally be fine over time, particularly if you don't this up and stick to the big ones. They generally do fine over time. So it can cover all of your sins, your terrible entry points, all your stupid mistakes. I think it'll be fine. So that's what I'm expecting next. We should be starting now. Let's talk about the dollar again. Dollar is a wrecking ball. Strong dollar lowers economic growth. The US Economic Surprises Index shows that it follows the dollar. The dollar has a 2-month lead. The dollar's strong. The economy slows down. So we're expecting to see the US economy slowing down over the next coming 2 months, and sharply so. The dollar is driven by the fears over the new Trump administration and what tariffs mean. And that has pushed the dollar higher and rates higher. And this whole thing is the exact same setup, and you and I have talked about this, of the dollar and rates in 2016-17. With the same set of Trump outcomes and tariffs and the same policies, it did the same thing. The first thing Trump did when he got into office was say, I want a weaker dollar. And he's already said rates are too high. So they're not stupid. They also know that they've got debt to roll, that they also have trade negotiations to do. So my view is they will use the stronger dollar as a carrot and a stick, which is China, you're going to have to devalue your currency unless you play ball with us. But if you do play ball with us, we will inject liquidity into the dollar system. We will lower the dollar. We will jawbone it lower. And you can then stimulate your economy, because the Chinese cannot stimulate right now without risking a breaking of the yuan peg, which they don't want. So I think it's all part of the Trump trade negotiations. And we know that the teams have already been kind of speaking to the Chinese and the Europeans and everybody else. When you go back to Besant, who I know decently well, Scott has made it clear that the dollar is too strong and that he would want a weaker dollar. You know, lower oil, weaker dollar. They want easy financial conditions because they want to win the midterms. And that's a big thing. Then there's the new guy who's coming in. I can't remember, Felix from Blockworks interviewed him. Can't remember his name, the Economic Council guy. Stephen
Buran.
Yeah, very interesting interview. And Stephen spent half the interview talking about at some point we're going to need a Plaza Accord if this continues, but we are going to have to get the dollar lower. Now, I don't think the Plaza Accord idea is this time around. I think it's probably closer to 2030 that people are just going to go, we can't deal with this dollar. Now, the dollar is structurally strong because the world is 50% in debt in dollars, and there's a shortage of dollars. The moment the US takes liquidity out of the system, it's a game of musical chairs, and it drives the dollar higher. So, you know, people will bid up for dollars. So that's where we are. We've also, as you talk about a lot, we are waiting for the injection of liquidity that comes as the reverse repo redrains back to zero, then probably the end of QT, and then the draining of the TGA. Also in the Fed minutes, sorry, I'm trying to get across a lot here. Also in the Fed minutes, the previous minutes, they had talked about that they're not keen to rebuild the TGA immediately afterwards and have a tightening of financial conditions. So what does that mean? I mean, either there's another way around it, or as you possibly suggested, it could mean QE, which sounds ridiculous now, but who knows? The other thing that this financial conditions is doing is pushing down forward growth expectations. And so it starts to make you think Q1, Q2 might be weaker, and that gives the Fed more cover also to cut rates. So this is from the January GMI. This chart at the top is, let me just get rid of that. This chart at the top is global M2 last time around versus this time around. And global M2 last time around, this time around, it's identical, which is kind of weird. Then we also have beneath it is the chart of the NASDAQ, and that's pretty much identical. So we have a repeat in the monetary conditions global M2 because the dollar was strong. That's what's pulling back global M2. It also caused markets to readjust. When we look at Bitcoin, we can see the phasing's out. But when you kind of match up the phasing, what happened, it was the 4th of Jan, we had a correction like we're having now, and then Bitcoin went up. And once you match the two, you kind of get a very similar pattern. So what we've got is, and also here's the economic surprises index and the DXY. It's been coming lower. It should drag the DXY, change rate expectations. Julian just put out a tweet this morning about all of that. So everything is here. Fed cuts may change because there's now like 25 basis points priced in. Okay, as a risk reward, there's a decent chance we get something. So it's like all the factors are in play, and whether the market sniffs it out or not, I mean, we got another week until whether we get fuller announcements beforehand or we have to wait for the inauguration and stuff. I don't know. I don't think liquidity affects inflation, really. I think they're driven by different things. You know, one is debasement, one is the price of goods and services, and I don't think they're necessarily driven by the same things. A lot of this is also the year-on-year base effect. So, and the central banks know that as well, which is why they've been saying, the Europeans, the US, everybody's kind of like, it's going to be a bit wiggly for a while. But overall, we still haven't fully deflated all the housing stuff that's back-end loaded in CPI. So it's going to be heavier than people expect. Also, we're expecting to see economic growth slow down somewhat. The SESI kind of says we're going to get weaker data. But, you know, anything now, like the high yields now, plays into inflation in 6 months' time, 12 months' time, i.e. lower. So the answer to inflation is having bond yields what they're doing. I still think by the end of this, inflation will undershoot, not overshoot, because of the weird dynamics that caused by the pandemic and this lagging of housing and rates being so high for so long. It doesn't affect Microsoft and Apple and Google or whatever, but it sure as hell affects anybody on a variable rate mortgage or anybody who's borrowing money elsewhere in the economy. But it takes time. The other thing that a low ISM indicates to you is that household earnings and corporate earnings outside of the tech are somewhat stagnant still, right? So the feedback loop we haven't had yet, even though the economy has been growing at, decent clip, the actual broadening out of economic growth with recycled earnings and profits hasn't really happened. So it's a very late cycle in that respect. The moment it does, it means that the structure of markets changes, small caps start doing better, alt season happens in crypto, it's all the same risk curve. Junk outperforms, all of this stuff starts happening the moment that happens. And we're still not there because of Fed rates, I think. I've just been surprised that the ISM has not followed the forward-looking indicators yet. But it feels like any month now, as you say, it's going to be up 6 index points and another 6. And then before you know it, you're in the mid-50s. And then you'll start to see it. And I think, obviously the Trump administration want that too, because they can't just be tech stocks that are winning. They want Main Street to win as well. And Trump in the end is a property developer. He understands the business cycle as well as anybody. I think everybody does. The Chinese, the Japanese, the Europeans, the Australians, the UK. I mean, everybody wants a weaker dollar. One thing I do know is Januaries have this lovely habit of blowing everybody up before the true trend establishes. In GMI, I've been writing for 20 years, I've never made a trade in January because January always gives a conflicting signal. And so the signal now is, oh my God, the markets, rates, this is terrible. And usually what happens is it completely reverses sometime in Jan or Feb, and the market then sets its direction. So I never read into Januaries.